Greetings to you, my financially curious friends. I'm on Bankrate.com. I've clicked on the Retirement tab and I've clicked Calculators. I'm looking at the traditional 401k or Roth 401k calculator. I just want to see what will happen if, for instance, we were 40 years old. I'm going to pretend that this is a single person who is 40 years old, has about 25 years to retirement, has $100 a month that it would be easy to put back into retirement, so a total of about $30,000 over the next 25 years contributed. All right. We are going to reinvest tax savings. Okay. We're going to assume a 9% return on investment. That's pretty conservative. You may have heard other people on the radio say 12%. You may even catch some people saying 15 and 18%. I think you can expect that in some way, in some situations, but I think 9% is a good conservative number. Let's pretend that right now you're making $60,000 a year, so your current tax rate is in that 25% bracket. But by the time you get to retirement, you're not going to be making, between Social Security benefits and other retirement monies, between maybe a part-time job and this set of retirement investment setback, it's only going to be about 15% tax bracket. You take a look, your Roth 401k with the new tax bracket will be worth about $106,000. Your 401k, the traditional one, you are going to create more money because the investment is earning money on the tax deferred amount, but when you pull money out of your 401k, the traditional one, you're going to have to pay money on those distributions. If you've got money in your 401k that's Roth, you don't pay taxes on that. So if I go and I take $1,000 out of my Roth 401k, I have $1,000 in my hand. If I take $1,000 out of my traditional 401k, I have $1,000 in my hand, but I also have a tax bill for $150. So it really means that by the time I settle up, I've only got $850 to spend. Okay, so that's the difference we're talking about. Now, let's pretend you've been carrying a balance on your credit card. You've been paying $250 a month towards your credit card. So not only are you losing the interest amount that you're paying to the credit card company or to the, I don't know, car loan or to the student loan, but you're also losing this investment money. Okay, so let's say you have $250 a month that you free up because you get your debts paid off. What does that do to our numbers? We come down to the bottom. We've left everything else the same. Okay, we're now not talking about $106,000 and $109,000. We're talking about $266,000 and $273,000. That's those amounts, and what we choose to live on is going to start changing our tax bracket. We'll save that discussion for a different day. Let's pretend you're making $60,000 a year. Let's pretend that you get really aggressive and downsize a house and you pay off all of your debt. So in fact, the downsized house means that you have no payments except for insurance, groceries, utilities, those month-to-month things that we can never truly get away from. But your $1,000 house payment is gone. Your car is fully paid for, and you've got money going back every month into your savings account to save up for your next car. Okay, it's that ideal wealth building position we're trying to get ourselves into. You have $750 a month to put back towards your retirement. Maybe the kids are out of college. Again, the house is paid for, so it's very few expenses. What does that do to your retirement? Okay, same assumptions there. Goodness grief. In just 25 years, you can build $800,000 or $821,000, depending on what you think is going to be the better deal for you. Right now, we're assuming that your tax bracket is going to go down. And so a 401k, the traditional way, might be the better deal for you. But look at what can happen if we start planning ahead rather than spending impulsively.